So we got about 210 U.S. housing markets that are at risk of a 15 to 20% price decline, according to Moody's. So welcome to Housing Bubble 2.0 News of the Week, or as I like to call it, another episode of As the Housing Market Turns or Crashes and Burns, right? Randy Patrick here, putting the realism back in real estate. Today is what? The 15th of September. And looks like the month is half over, so hope you're doing well. This video, of course, is brought to you by our friends at Foreclosure.com. If you want to check out the distressed properties, the things that I really talk about on this channel, and you want to see what's going on in your neighborhood, go to gethousingdata.com. That's gethousingdata.com. That's my affiliate link with Foreclosure.com. You can check out, there's a free trial. You can see what's going on literally in your own backyard. Very powerful tool. You should check it out, guys, gethousingdata.com. Okay, so interesting article here. 210 U.S. housing markets at risk of property value declines in the 50 to 20% range, according to the chief economist at Moody's. So ultimately, in the end, before that, I thought I'd throw this in there. This week, doing a training call, September 15th, between 8 p.m. Eastern Time, 5 p.m. Pacific Time. New developments and strategies in the pre-foreclosure market, the foreclosure auction market. This is happening real time. This is for program members, so people that are in my program. So I did send out some general emails on that, but if you just thought I'd put it here on the video so you know that it's actually happening. So some people actually watch the videos but don't pick up their emails, etc., etc. Anyway, in 2 days, it's Thursday evening, we're doing this right now. If you want to get on the call, how do you get on the call? Email me and jump on one of my programs, and we'll go from there. Okay, guys? All right. So so basically they're saying we're beyond questioning whether a housing correction will push home prices lower. It's actually happening right now. So we have a bubble. The bubble's bursting. We're correcting. Are we crashing? That's, I guess, what's going to happen here. Earlier, the chief economist of Moody's, named Mark Zandi, was talking, saying he expects national home prices to decline up to 5% from peak to trough. And if a recession hits, he expects that's between 5 and 10%. Then this is a national across the board, so everything has to kind of average out. Well, clearly we're kind of in a recession. I don't know about you, but if you take a look at all the recession indicators, we're there. So expectations are we're going to see it's no longer if, it's really when, or we're in it right now. So in some parts of the country, this ongoing home price correction doesn't expect it to bottom out for another 12 to 18 months. It could be much steeper in different locations. We're talking 15 to 20% property value declines in those significantly overvalued housing markets. So we're trying to bring things back down to earth. Now, 183 of the nation's, 183 of 413 of the largest regional housing markets across the nation were overvalued by more than 25% back in Q1. If we go to what's happening in Q2, that figure grew from 183 to 210 markets. So basically, 210 markets across the U.S. have a 25% or greater, percentage of being overvalued. Now, simply put, over half the nation's regional housing markets are vulnerable to home price declines of 15% to 20%. For perspective, from peak to trough, U.S. home prices declined 27% between 2006 and 2012. That's on the national index. You can certainly verify that by going to look at Case-Shiller. Whenever I talk about Case-Shiller, I have that sort of bar graph that I show you, and it shows exactly that. Between 2006 peak to 2012 trough, it was a 27% across the board national blended, housing metro index. That's the national index. That's the rate it went down. So, if we're talking 15 to 20% right now, happening in the future, and again, every time we talk about these numbers, I do believe there always is an air of conservativeness with this. Because people don't want to come out and go, hey, we're going to have a crash and we're going to lose 40, 50%. Nobody wants to do that. That's basically, that's what I'm looking for. It's commercial, it doesn't go well for your business or making those type of claims, especially if they don't come true. But again, I say that, everything we talk about, everything that's being written up there is still more conservative as opposed to, what could be really happening in the marketplace. Nobody wants to call out and be aggressive on that. So that's kind of the thing here. So again, places like Boise, overvalued by 72%, Charlotte, 66%, Austin, 61%, Vegas, 59%, Phoenix, overvalued by 57%. So these are markets that are really exposed here. So these markets got blindsided by the pandemic's work-from-home revolution, which basically attracted people from California, New York, other locations to come to the state, come to those locations and spend money, but they also saw a flood of investor buying. These investors, often flippers or landlords, wanted in on historically low mortgage rates and record home price appreciation. So you had the best of both worlds the past couple of years, low interest rates and watching home values skyrocket. Okay, but underlying housing fundamentals tells us that many locals in places like Austin or Phoenix were already priced out even before we entered 2022. They'd already hit their peaks. There already was buyer fatigue. There already was pullback going on in the investor community. But now that mortgage rates are spiking, many of the work from home buyers who were attracted to markets like Boise because of the relatively affordable real estate were also priced out. So basically cueing the steep price cuts now you're going to see in markets like Phoenix, etc. So that's the issue. So you still want to jump in those markets where you're not going to pay those high prices. You don't want to. The market has to adjust because interest rates are so high and have pushed everything to be really unaffordable now. So this is interesting though, and I guess my point to everybody is here. We've talked about this for quite some time, and I get it, guys. Listen, I get it more than anybody else does as to the length of time this is taking and what's going on. But good things do come to those who wait. All right, and things do change for the better for the housing market, and there has to be a reset. Now, remember, actually, let's just point this out here. Head of research at John Burns Real Estate Consulting basically say our view is that housing is going to continue to feel it and have this reset mode. The affordability resetting mechanism right now that has to happen is on home prices. So there are a lot of markets across the country where we're forecasting that home prices are going to fall double digits. So here you have an independent consulting group, John Burns, which is fairly renowned for being out there with respect to talking about new home construction and the housing market and things like that. They're using the key words here, which are reset. Okay, so to me, a reset and falling by double digits. Well, what did we actually find out about being reset? Well, ultimately, in the end, if you take a look at it, the Fed, I did this video back in June 21st, that's the thumbnail. The Fed came out after one of their meetings and said, we have to reset the housing market. So they're actually doing that. They're doing that how? By trying to curb inflation, by raising interest rates, which in turn will reflect or impact mortgage rates, and they're rising. They've risen quite a bit and will continue to rise. Now, what's happening next week? Well, expectations are that the biggest Fed rate hike in 40 years could be coming next week. So inflation came in, I think, above expectation, or I forget the numbers. There were a few percentage points off, but it was supposed to come in at X. It came in at Y and was higher. So basically, from what the leakage is with respect to what's going to happen next week, and this is the next slide here, the Fed mouthpiece speaks at least a 75 basis points next week. Odds of 100 basis points rate hike have increased. So obviously, there's odds makers and people who are saying, yeah, we're going to have, what's the word I'm looking for? We're going to have a rate increase for sure. Here's the odds of a 0.75, and then here's the odds of a 1. Okay, so obviously 0.75 pretty much guaranteed, baked in. The 1 still is getting, it's about almost 50% potential that we're going to have a 100% basis point increase. So there you go. Again, so what does this do for the housing market? It's going to make it even more unaffordable, which means it's going to put more downward pressure on price points and things like that. So that's what we have to look forward to. So for me, this is pretty interesting, and this is actually playing out right before our eyes. So, again, this is what's going on in, I guess you could say, real time. We have the ability to figure this out as the market goes. By the way, everybody, if you appreciate the information in my videos, if you do me a great favor and subscribe, I'd really, again, I appreciate that. Thank you very much. For those of you who think you're subscribers, could you please reaffirm your subscription? Reason being, I always lose subscribers for whatever reason, and people don't get notified of my videos. So if you could resubscribe, again, I thank you very much for that. Okay, moving on here. Interesting enough, with respect to this market and why it's so interesting is the fact that we got another heat map here. So this is part of the article, obviously, and I actually blew up the bar where the color bar part of the bar so you can see it. So the degree to which regional home prices are overvalued or undervalued according to Moody's Analytics. So clearly the darker the orange to red or whatever that color scheme is there, auburn, burnt auburn, whatever, the darker, the more overvalued. So we can take a look at, well, we see the darker red where, in Arizona area, in California, in the Northwest, in places like Denver, obviously the Texas area where you've got Dallas and Austin area and Houston, obviously certain locations, across the country, and sort of, the Tennessee, looks like Tennessee or North Carolina areas as well too, Atlanta, South Carolina areas along the coast. We've got some areas, up, looks like, I can't tell there, but Virginia areas, okay, obviously a little bit quieter in the Pennsylvania areas, Michigan growing, Florida. Look at Florida, very, very dark red. Okay, very, very dark, almost as dark as you could be there. I can see that one area there. Looks like the above West Palm, that area there, Port St. Lucie area, etc. So again, when we're taking a look at this heat maps, this is the overvaluation, right? So typically, what comes up does come down, and they say the bigger they are, the harder they fall, which is true. So a lot of the markets, basically have had massive appreciation, and they're poised to come down. So when we're talking 15 to 20% in some of these markets, it could actually be a lot bigger. And that's the thing. Going back to what I said a few minutes ago, yeah, anybody that's going to comment on how much we're going to lose, they're going to be conservative. They're not going to come out and say what they really feel, just because we know that's, we call it political or employment, I guess you could say you're doing yourself in, basically, right? So you have to watch that, and they know they have to, and they don't want to send the markets into a tizzy. But the point is, this is expectations. Now, relatively speaking, yeah, if we're 67% above the peak of 2006, if we see a 25 or 30% pullback, we're still 30% above 2006. So there's still appreciation there, but it's not this exponential appreciation. So what we're going to be seeing is essentially the wiping out of the high exponential curve is what we're going to see, right? I think we'll retain the linear appreciation that's happened, but we're going to wipe out the stuff that's happened over the past couple of years to get us back to a normal housing market here. So that's sort of what I think is going to happen. Are we going to lose 50%? I don't think so. Maybe in the 30 to 40 range. It's going to be market dependent, of course, like that. But again, the point is, it's actually happening now, and I really think it's interesting how it plays out. And this is sort of this kind of explains it here. So if you go back to early January 2022, before the chaos, everybody was talking about what a great housing market we're going to have, and we're going to see double-digit home price appreciation again for this year. Everyone, CoreLogic, Zillow, Redfin, everybody predicting all this type of stuff, right? Well, guess what? That didn't really happen, okay? And once sort of we got to some rate increases and there was some lack of confidence in the marketplace, and we saw a lot of builders having some inventory as well, we saw what was really an underwhelming summer selling season. So in different parts of the country, the summer selling season ends in August, like in the South, because school starts earlier. To me, nationally across the board, after Labor Day, it's officially over. Now we're into fall, and everybody gets back to normal with no more vacation, school starting, whatever. So now we did have an underwhelming selling season. Okay, we see the fact that more listings out there. We see price reductions on those listings. We're seeing fewer bidding wars, if any. We're seeing contract cancellations. If we even talk about things like pending home sales, so the pending, which is things under contract for the future, pending home sales is down, which means future closings. So that'll mean less sales. All right, so we're seeing that volume drop down, and the need for housing drop down too. Why? Because people are tired, and they're not going to pay. They're not going to overpay for a property. Number one, and number two, have a high interest rate. Well, the Fed in June, right, June 21st, basically said, we're going to reset the housing market, because they exactly said that. We see price point is out of control now, and we need to bring this back down to reality for the average home buyer and the first-time home buyer. So the Fed has come out and said we're going to reset the housing market. To me, that's pretty aggressive. It's their desire to curb inflation, and that's what they're going to do in the housing market. And that to me means we're going to crash the market. I think the two words that we're saying now are affordability issues. That's a bubble, right? And reset the market. That's another word for crash. So basically, here we go. So now we've gone to price decline prediction. So before it was, again, earlier in the year, we're talking about home price appreciation in double digits, and now we're talking about, openly, narratively speaking, in the media, now we're talking about price declines, 15 to 20%, okay, if not more. So I guess, to me, it just goes to show what can happen in a span of 8 or 9 months. All right, so that's how, and things can change differently. Things can change faster. I think we are going to change faster, and this is going to hit us pretty hard end of the year and early next year. So that's, again, the reason I put that up, because I wanted to show where we've come from to where we are today in such a short period of time, which I find very interesting. So, but here's my kicker on this, is the fact that there still is little to no talk of what? Delinquencies, mortgage delinquencies, defaults, whatever, serious delinquencies, etc. Forbearance. We hear some forbearance every so often. It's usually the wins. Oh, there's less people in forbearance programs because their forbearance programs have timed out. They're over. Okay, we don't hear about what's going on behind the scenes in the loss mitigation world, and we don't hear about the foreclosures. Okay, so remember all this price correction and predictions of 15-20% or more. That's just based on today's marketplace with interest rates and things like that, and the economy and inflation. Nobody's factoring in what's going to happen when stuff like this actually starts to hit the fan. It's starting now. Okay, so we're at the cusp of it. It's going to build. We're entering the first wave of the 3 waves of the foreclosure tsunami. If you follow my other videos, that's what I've been talking about. Okay, so that's where we're at right now. So again, still, why they're not talking about this, I do not know. Maybe because it's hard to grasp and hard to handle, and people still really don't know how it's going to play out. So I look at it going, if we're going to have 15 to 20% decreases just based on today's environment in real estate, expect another 15 to 20% when the foreclosures come. All right, that's how I look. They'll double up on things. So that's as simple as that. So that's the scoop, guys. Oh, just, I like to show a location here and there. This is Richland County, South Carolina, which really encompasses Columbia, South Carolina. 740 pre-foreclosures sitting around right there right now. So if people are going, like, nothing for me to buy, nothing's out there, 740 people aren't paying their mortgage around Columbia, South Carolina. If you live there, there's probably some good opportunities if you want to go fishing. Okay, so again, everything is available. You just have to either want to or know how to go get it. Okay, so that's a scoop on that. Again, as I mentioned earlier in the video, training call coming on Thursday, which is tomorrow night. So look for my email. If you're not getting my email, let me know. If you're in one of my programs, and I'll give you the login information. If you want to be on the call, you need to be in one of my programs. Connect with me as well too. Which leads me to the fact that, what do I want to do? Looking for, you've seen this these for the past little while now. Looking to expand here. Things are happening. Deals are starting to happen. There's more stuff going on. All right, I can tell you all about it. You need to get in the game now. Don't let this pass you by. All right, simple as that. Again, my new program I'm launching right now, it's pre-sales, and we're going to have a great, awesome opportunity coming the next little bit with respect to what's happening in the marketplace. So get involved in this. We're talking everything from foreclosure auctions to REOs to short sales to taking deeds to subject to the whole tax deeds, the whole bit, the whole game plan on the distressed property world. All right, so that's the deal there. And basically, if you want to get a hold of me, that is my email, so feel free to reach out and connect. All right, guys, once again, thank you for the views, likes, comments. Please share the video with your family and friends. If you're not a subscriber, please subscribe and help my channel grow. I look forward to speaking with you before the week's ended. Bye-bye.